Earnings conference call hosted by Investec Capital Services India Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vinit Prasad from Investec Capital Services Private Limited. Thank you, and over to you, sir.
Thank you, Muskan. Good afternoon, everyone. A warm welcome on behalf of Investec India to Q3FY25 earnings call of Afcons Infrastructure Limited. Today we have with us the senior management team represented by Mr. Subramaniam Krishnamurthy, Executive Vice Chairman, Mr. Paramasivan Srinivasan, Managing Director, Mr. Ramesh Kumar Jha, Chief Financial Officer, and Mr. Hitesh Singh, Head Corporate Strategy. Now I would like to hand over the call to Mr. Subramaniam sir, Executive Vice Chairman, for his opening remarks. Thank you, and over to you, sir.
Good afternoon, ladies and gentlemen. I am pleased to welcome all of you to the Q3 of FY25 earnings conference call of Afcons Infrastructure Limited. Our financial results and investor presentations have been uploaded on the exchanges, and I hope you had a chance to review them. Joining me today, Mr. Paramasivan Srinivasan, Managing Director, Ramesh Jha, Chief Financial Officer, and Hitesh Singh, Head Corporate Strategy. Let me start by giving all of you some business updates. Afcons total income was 3,332 crores in Q3 of FY25 as compared to 3,182 crores in Q3 of FY24. For 9 months of FY25, the corresponding figure stood at 9,635 crores compared to 9,837 crores in 9 months of FY24. Let me turn to our profitability metrics. In Q3 of FY25, our EBITDA stood at 448 crores, making a 14.1% year-on-year increase compared to 393 crores in Q3 of FY24. EBITDA margins expanded by 111 basis points to 13.5% during the quarter. For the 9-month period, EBITDA reached 1,247 crores, growing 13.3% year-on-year while maintaining a healthy margin of 12.9%. Moving to PAT, we delivered a 35.7% surge in Q3 of FY25, with profits rising to 149 crores from 110 crores in the same period last year. This translates to a PAT margin of 4.5%, up from 3.4% in Q3 of FY24, reflecting improved cost management and higher profitability. Cumulatively, for 9 months of FY25, PAT grew 23.3% to 376 crores, reinforcing our ability to sustain momentum even in the competitive environment. I'm happy to share with you that CRISIL ratings have assigned AA- with a stable outlook for long term and A1+ with a stable outlook for short-term ratings to the bank loan facilities and commercial paper program of Afcons Infrastructure Limited. This is an upgrade from the earlier rating of A+ for long term and A1 for short term. The rating reflects the strong business profile of Afcons, demonstrated by its established track record and ability to execute complex infrastructure engineering projects in India and overseas. Additionally, Afcons has been included in the MSCI India Domestic Small Cap Index, which will be effective from 28 February 2025. Speaking about infrastructure sector updates and growth prospects, we see strong continued growth in the infrastructure construction space, evident from government's clear vision of becoming a developed nation by 2047. As highlighted in the recent economic survey, India must sustain an annual growth rate of 8% for at least a decade to attain developed nation status by 2047. Also, as aptly mentioned, infrastructure is a key enabler of this goal, with significant scope available for improving multimodal connectivity, public transport, and disaster resilience in urban areas. Infrastructure development, particularly in the segments we operate, are key to achieving this growth. Various policy initiatives by the government will ensure efficiency in the government's infrastructure investments. Strategically, we continue to leverage our expertise in delivering large-scale complex infrastructure projects across India and globally Our unique ability to execute projects across diverse infrastructure segments, be it is marine, industrial, metro, underground or elevated, bridges, highways, tunneling or hydro, sets us apart in the industry. Over the decades, Afcons has demonstrated the ability to successfully deliver across all major infrastructure verticals. This makes us a formidable and a differentiated player in the Indian infrastructure space. We also continue to build on our core strengths, which we have developed over time, such as knowledge management, risk management, and operational excellence through innovation. Our commitment to these areas have been recognized through multiple prestigious awards, most recent being Most Innovative Knowledge Enterprise Mike Award of 2024, recognized for the 7th consecutive year at both global and India level, reinforcing our leadership in knowledge management. IEI Excellence Industry Excellence Platinum Award 2024. This is our 4th consecutive year of recognition for innovation and operational excellence in construction. We remain committed to investing in technological advancement, digitization, cutting-edge engineering capabilities to improve efficiency, execution timelines, and overall project delivery. In conclusion, Afcons Infrastructure remains dedicated to creating value for our stakeholders, customers, and all our shareholders. Thank you for your support and trust. I will now hand over the call to our Managing Director, Mr. Paramasivan Srinivasan, to offer a deeper understanding on the developments and our future path. Thanks a lot. Thank you.
Thank you, Mr. Subramanian. Good afternoon, everybody. It's my pleasure to welcome you all to Afcons Q3 earnings call. We appreciate your continued interest and in support in our journey. I'll just give a broader business landscape, business procurement, and important updates. In the recent budget, despite significant measures to boost consumption and the associated pressures on fiscal consolidation, which is an excellent step taken on the fiscal consolidation, the government has allocated 11.2 lakh crore for capital expenditure, a 10.1% increase over the revised estimate of the last year. This underscores the commitment, the continued commitment of the government to infrastructure development, which is once again reiterated by FM's statement yesterday. It will be a middle class focused and an infrastructure focused approach towards reaching Viksit Bharat by 2047. The government's alignment with this perspective is evident in the healthy allocation for roads, railways and metro projects and special push through state governments. This will be very significant in many states, of 1.5 lakh crores 50-year interest-free loan that I think many states can use to raise resources using this fund, further using the resources. That will go a long way in terms of infrastructure development. And National Monetization Plan, the phase 1 has been hugely successful. Hardly 20,000 crore is a shortfall in the phase 1. And in the phase 2 now, whatever is announced, I am pretty sure with a 3-year pipeline what is made, will go, the National Monetization Pipeline will go a long way in terms of improving the finances. And there is a revised PPP model being attempted, and there is a 3-year, along with a 3-year project pipeline and all. That I think will be a work in progress as you look at it in this thing. Because PPP in India, PPP has moved to HAM, and again moving back to PPP. How it is going to work, we need to see. And the government has announced establishment of export promotion mission, which is very positive. This is something which I must say government has acted based on feedback by many exporters as to some of the areas of improvement required. And also government's own push to see that top Indian companies become top global players as well. So from that angle, they have created an export promotion mission to address non-tariff barriers, facilitate credit access, and provide other forms of support to enhance exports. This initiative is also expected to focus on project exports, including those funded by the government. And as I conveyed earlier, the government is developing a strategy to elevate select Indian project exporters to compete with global peers. And Afcons, along with other leading project exporters, will engage with key ministries and also with Niti Aayog to advocate for supportive policies in this regard and the initiatives required in this regard. If implemented, these recommendations could drive a substantial expansion in India's project export footprint. Overall, the government's continued focus on infrastructure development will provide a strong impetus to this sector. This positions large, diversified EPC contractors such as Afcons to capitalize on emerging opportunities and contribute meaningfully to the nation's infrastructure development. And internationally, with the export mission and also our continued focus with some strong private clientele like ArcelorMittal, gives us better revenue visibility. The LOC projects by Government of India has seen a slowdown from Exim Bank. And however, there are select geographies, as we have been mentioning, wherein there is a good visibility in terms of wherein the competition is restricted to some European players, Turkish, Indian players like that, in Eastern Europe and some of these countries. And also, as indicated as a part of our strategy, bigger projects in Middle East with local partners, that is also taking shape from the futuristic angle. In terms of business development, Afcons continue to strengthen its position, and as of 31st December, we have a 38,000 crores of pending order, and which excludes about 10,662 crores of L1, and 14,603 crores is the amount of order we have booked in the first 9 months. And in the first month of the current financial year, now before the first 45 days, we have already received 1,283 crores from DP World, and with that, our order book is almost at 16,000 crores as of now. With the 10,662 crores further L1, I think we are slated to achieve about 30,000 plus in the current year, with some more tenders expected to be opened shortly. With this, we would say we would have reached the highest ever order book in terms of for the year, and at the end of the year, we will be somewhere between 45 to 50,000 crores order book, giving us more than 3x visibility for the future period. And this will clearly give revenue visibility for the next couple of years. And as we conveyed earlier, while the current year we expect ourselves to be the flat or marginally higher growth, next year we expect 20 to 25% growth from that of current year, more towards 25%. That is what we are looking at. And Afcons continues to set the benchmark in the infrastructure sector with notable achievements and industry applause. As per latest Engineering News Record 2024 rankings of USA, we are ranked 139 in the top 250 international contractor list, reaffirming our global presence. In terms of marine, we are rated as the 14th largest. In bridges, we are the 12th largest. In transportation, 45th largest. In aqueducts, 12th largest. And in water supply, 38th largest. In marine, we are the highest ranked Indian contractor. In bridges, we are the only Indian contractor within the top 25. In transportation, we are the only Indian contractor within the top 50. And these are very, very happy tidings in our international presence. And our Delhi-Meerut Rapid Rail project is inaugurated by our Honorable PM. Of course, it's not entirely our stretch. Partly our stretch is also included over there. And we have won several awards, ET Infra Leadership Award for our Calcutta Metro and Maharashtra Samruddhi Package 14 Excellence in Transportation Infrastructure. National Safety Council has awarded 5-star rating and the Shield for our Liberian projects. So unwavering commitment to innovation, execution excellence and safety is continued to be given, accredited by various agencies. This reinforces Afcons' position as a leader in delivering world-class infrastructure. In conclusion, Afcons remains strongly positioned to capitalize on emerging opportunities in the infrastructure sector. With a robust order book, we are confident. With a robust order book, a strategic approach to business development, and a strong track record, we are confident on delivering sustained growth and value for our stakeholders. Thank you all once again. While I conclude my remarks, hand over to our CFO for providing review of the financial results.
Good afternoon, everyone. Before I get into the numbers, first I'll just talk about the rating upgrade we have got done. We are very happy to inform you that we have got our credit rating upgraded to AA- for long term and A1+, which is the highest rating for short term from CRISIL. Moving into AA category will open up the money market instruments like CP, NCDs to us, and this will give us a lot of interest saving arbitrage opportunity. This should also help us bring down the interest rate going forward. Now, on the numbers we have talked about last time also, I'd just like to reiterate, the company is into the business of construction. The margin in a quarter varies based on the nature, type and quantum of work we execute. So quarterly results may vary in different quarters and may not be indicative of annual results or trend. Now, moving to specific numbers, during Q3, we have done a top line of 3,332 crores as compared to Q3 in the previous year, 3,182 crores. And the previous quarter, Q2/25, we had done 3,090 crores. And if we look at the top line number for 9 months, we have done 9,635 crores as compared to previous year 9 months, 9,837 crores. Now, during this quarter, we had a growth of around 5% year-on-year and around 8% quarter-on-quarter. Because of the acceleration in the turnover during Q3, this has narrowed the YOY gap to 2% in 9 months from the previous 9 months period. Because in Q2 we were 5% down from the previous year number. Since there is an increased pace of execution now we are seeing in recent months, so as things stand, we should close the year on a similar top line or a nominal growth for this financial year. As far as revenue guidance is concerned, this year we are looking at a flat growth or maybe a nominal growth. This is because of our muted order booking in last 2 years, which we had talked about earlier. But since this year, we have already bagged close to 27,000 crores of orders, including the projects where we are L1, which we are quite hopeful that we should be getting very shortly. All these projects will mature for construction in next financial year, wherein we are looking at a growth of 20 to 25%, more towards the upper trajectory. On a medium to long-term horizon, we would like to sustain our CAGR, which we have achieved over a longer period of time, say last 10 years. So we should be around those numbers, which is around 15%. Now, moving to EBITDA, during this quarter, we have done 448 crores of EBITDA. As against Q3/24, we have done 393 crores. So in terms of percentage, this quarter we have done 13.5%, and this is up by 111 basis points from the previous year. In the 9-month period, we have done 1,247 crores of total EBITDA, which is 12.9%, and this again is up 175 basis points from the previous year, wherein we had clocked 11.2%. Now in EBITDA, I would just like to clarify that in our EBITDA calculation, we have considered BG commission as part of our operating expenditure. So EBITDA that we are talking about is after removal of BG commission as an operating expenditure. Whereas we understand that the street considers BG commission as part of interest or finance cost. Hence, if you consider it that way, then the EBITDA will increase to the extent of 125 crores, which we have excluded. Also, in our EBITDA calculation, we have included other income as part of revenue. Here we have explained earlier also that our other income needs to be understood in the perspective of our business. Arbitration interest, foreign currency exchange gain, and miscellaneous incomes are recurring and very integral to our business. Hence, this needs to be considered as other operating income. So for the 9-month period, the 311 crores of other income we have considered as operating income while calculating the EBITDA. So these EBITDA percentage, what we have achieved for the 9 months, 12.9% for this financial year up till the 9 months. This year, as things stand, we expect the number to be higher than what we have been given a guidance. We have always talked about that we are going to maintain our EBITDA 11% plus. Reason being, we are maintaining this, that construction is full of contingencies. Our endeavor will be to save on those contingencies or optimize it, but many a times we may not be able to save those contingencies. Hence, our guidance will remain at around 11%. Now, moving to profit after tax. But I again reiterate that this financial year we will be having an elevated EBITDA margin since we have already achieved 12.9%. Moving to profit after tax, we have done for this quarter 149 crores as against 110 crores we had done last Q3 last year. This again is 102 basis points up in terms of percentage points. For the 9-month period, we have done 376 crores of profit after tax. This is 3.9% of the top line of the total income. This again is 80 basis points up than the last year number. In finance cost, we have seen the kind of optimization we were expecting. So there is a saving in interest cost because of the IPO proceeds we used towards debt repayment, but this got negated because of change in mix of interest-free versus interest-bearing advances. Usually, in the total portfolio of advances we were having, 75% used to be interest-free and 20 to 25% used to be interest-bearing advances. But this time around, the projects we have backed, we are seeing 70 to 75% projects are interest-bearing. So that's where we have saved on the bank interest, but interest from client advances have increased. So that's where we are not seeing any benefit on the interest cost front. But the projects have been tendered in such a way that these aspects have been factored in the project, so our margins are going to remain intact. We have also continued to account for accelerated depreciation on our TBMs. Of the total 367 crores of depreciation, around 1/3 is on account of accelerated depreciation in that. So the trend continues. Now moving on, the return ratios for the 9-month period, we have clocked a ROCE of around 16.6% and ROE of around 12%. So here again, I would like to clarify that the capital infusion has increased the capital base, but operations are yet to elevate. Hence, returns in short term are showing some dip. Right indicator for the return ratios are annual numbers. Even though we have clocked in excess of 16% ROCE and around 12% ROE, if we factor in the accelerated depreciation, our ROE will be, at a very high level. Also, these returns need not be looked into isolation. This needs to be looked in the perspective that it is over and above the impact our projects are creating on the society. Moving to the debt, we have closed the 9-month period. Debt has come down to the level of 2,692 crores on gross basis, and on the net basis it is around 1,788 crores. On the net basis, the debt equity is working out around 0.35 times of the net worth. Order book we have already talked about. So on behalf of Afcons Infrastructure Limited, I thank everyone for attending this call. Now I request moderator to open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Jainam Jain from ICICI Securities. Please go ahead.
Thank you for the opportunity. So, sir, my first question was, what is the order inflow guidance for FY26?
FY26 order inflow guidance is 25,000 crores.
20? Sorry?
25,000
crores. Okay, sir. And how are we seeing the order pipeline currently? Like, what is the order pipeline?
What is the order pipeline?
Yeah. So the prospective, as you understand, our projects are long gestation projects. So our order pipeline we generally monitor on a rolling basis of around 2 years. So currently we have a visibility of around 3.46 lakh crores of orders, and they are spread across the segments where we are visible. As rightly so, the largest visibility we have in urban infrastructure, which is close to a lakh crores. Surface transport, which is our road and rail business, there also we expect a good number of orders to come. Around 90,000 crores is the visibility in that area. Hydro underground, which includes dams, pump storage schemes, tunnels, that is around 80,000 crores. And marine is around 60,000 crores. So that is the visibility we have for the next 2 years.
Okay. And so what is the project value for which we have bidded currently, like for the tenders which are yet to be open and we have bidded for?
Well, on a rolling basis, around 40 to 45,000 crores of tenders are being bid by the company across verticals. And that it keeps on, some projects we won, some projects we lose, but around 40 to 45,000 crores is on a continuous basis.
Okay. Are there any major projects we are expecting the tenders to be floated in coming months, in terms of metro or urban infra projects?
Sorry, your voice was not clear. Can you please repeat the question?
Are there any major projects which we are expecting the tenders to be floated in the coming months, in which we are planning to bid?
There are quite a number of projects. Two specific projects which we can mention is one is Dubai municipality, where there is a big sewage tunnels are coming up by tunnel boring machines, where we are already pre-qualified. That's in this thing in consortium with couple of others. It's about $3.5 to $5 billion each. That is coming up in the next 3 to 4 months. And in domestic in Maharashtra, we have the Binder-Virar connectivity, which is coming up, which is about 75,000 crores of jobs split into 6 packages, JICA funded job. So that is something which is again a marine project, a marine bridge, which will be a specialist project. So there also, this is the another big project. The third big project which is coming up is a tunnel under Brahmaputra in northeast, where in Assam. That is also in the pipeline. These are some of them. There are a number of other projects. Vadhavan Port is coming up with 2 projects, breakwater and desalting tank. Andaman Port is coming up with projects. And there are a number of other bridge projects are in the pipeline. Okay. I'm just giving the flavor of big projects where limited the pre-qualification possibilities and others.
Okay. And anything in metro segment?
In metro segment already we have bid for Indore underground metro. We have bid for Patna underground metro, and it's on a continuous basis. Recently, government has announced expansion of NCRTC, where we have done one elevated, one underground. So there going to be a big investment coming up. That was already sanctioned long back, but now it is put into action. So that is coming up. And everywhere the expansions are taking place in the metro projects. In Bombay has announced expansion of metro, and Delhi has announced, and Chennai has announced expansion in Chennai and also extension to Coimbatore and Madurai. So number of places metro expansions have been announced.
Okay. So we expect all the tenders with in FY26.
And in terms of urban infrastructure, we expect continued growth. And that is something where the government is also pushing quite a lot. And in marine, we find a good opportunity currently in the domestic market, which was not there for the last few years because of Vadhavan Port, Andaman Port and similar. And this thing in terms of surface transport, I think it will be left more to the specific states as NHA projects, as you mentioned, that it's become very crowded. Therefore, it depends on more state-specific projects, which a number of states have come up with proposals, and with the government also giving in 50-year interest-free loan, which they can use as equity towards raising funds. So that will go a long way for state-level related development. Therefore, in terms of project pipeline, we don't find much issues. That's on the domestic market. International market, as I told you, Dubai is there. Saudi, we have a focus currently. And Africa is slowly coming back, reviving back after post-COVID. That gives an opportunity to us. And some of the European markets, which we mentioned earlier as well, we have been focusing on, we are submitting our bids. So that will open up opportunities for us. All these are funded projects by multilateral institutions.
Okay. And so I wanted to fill in this work capital. So the numbers on inventory, trade receivables, unbilled revenue, trade payables, and mobilization advance.
So if you are looking for number for December, so you are looking at any specific number?
So I said inventory, trade receivables, unbilled revenue, payables, and mobilization advance. This number will help us to analyze the working capital.
Yeah, so trade receivables, and see, I'll tell you, as far as the net working capital is concerned, net working capital is still at an elevated level because we still see delays in certification of the work done and release of payments in some projects. This has led to the increased uncertified work and receivables, leading to jump in working capital requirements. Generally, this trend remains during the year, wherein bill certification and payments are not up to date. So we see the elevated working capital requirements and borrowings in Q2, Q3. And this gets sorted out by Q4, and that's what we are expecting this time around also. Now, to give you the specific numbers, the trade receivables are 3,140 crores. The inventories are 1,576 crores. Unbilled revenue is 6,134 crores. And the advances from customers is 2,383 crores.
And trade payables?
Trade payables are 4,024 crores.
4,424 crores. Okay. That answers my question. Thank you so much for the opportunity and all the best.
Thank you.
Thank you. The next question is from the line of Mahesh Bendre from LIC Mutual Fund. Please go ahead.
Hi, sir. Thank you so much for the opportunity. Sir, I heard that the guidance for next year is around 20-25% revenue growth. Is it right, what I heard?
Yes, that is right.
Okay. And sir, some of our peers were indicating that there is some kind of payment delays happening from the state governments and many agencies in terms of construction projects. So, have we witnessed anything like similar situation?
So see, it again depends from company to company with which counterparty they are working. So as we have in past said that we are very focused when we approach any project, and the risk management practices the company has put in place not only helps us in selecting the project, but it at times it helps to remove some of the bad projects. So we have not had a similar experience, but to mention, we also had Jal Jeevan Mission projects, and there the bill certification and payment issues are there.
Okay, sure. Thank you so much, sir.
Thank you.
Thank you. The next question is from the line of Bhavin Chheda from Enam Holding. Please go ahead.
Good afternoon, sir. Overall, good set of numbers and a very strong order intake and a very strong guidance for next year. So just a few questions. I think you mentioned in first 45 days of this quarter, you have received fresh orders of around 1,100 crores. That's the number you mentioned. I missed that number.
80 crores, 1,283 crores is a marine project from DP World in Gujarat.
Okay. And so you mentioned there is a 10,600 crores L1 plus this 1,200, and already our order intake for 9 months was 14,600. So for the entire fiscal, we would be crossing an order intake of over 25,000 crores, right, sir?
Yes, with the L1 already considered, we are already at about 27,000 crores. We do expect another 1 or 2 orders to flow into the company. With that, we will be closer to 30,000 crores.
Closer to 30,000 crores. And for FY26 order intake, you mentioned is 25,000 crores fresh. That is, as of now, you are estimating.
Yes.
Okay. The other question was on the higher interest cost. The reason you mentioned was the client advances. Now almost 75% of the advances we have to pay interest versus earlier where 75% of the advances were interest-free. So has this happened on a specific segment or specific orders received now, or now this has been the general phenomena across all orders?
No, so this is not a general phenomena across. It actually depends that in which segment we have booked the order. So if you see the order booking we have done, generally in metro, in high speed, overseas projects are interest free. So these projects, recent past we have not backed, but as MD was explaining and Hitesh also explained that the projects we are targeting or in the pipeline are in the segments where interest free advances are available. So the percentage I have talked about is for the projects we have backed this financial year. Now, as things stand, on an overall portfolio, the composition may undergo a bit change, which earlier used to be 75% interest free and 25% interest bearing. Maybe that number might be around, say, 50-50 at the moment. But with the fresh influx of orders, we are quite hopeful that we will get back to a similar situation.
Okay, so interest cost may slightly subsidize as going forward as the order makes changes.
Yes.
Right. And the last question on the accelerated depreciation, we appreciate your accelerated depreciation policy to write it off as versus the other companies in the sector. The number you mentioned was 1/3 of the depreciation amount is still on the accelerated part on the TBN?
So what I said is in 9 month period, we have 367 crores of total depreciation cost. Of that, around 1/3 is towards the accelerated depreciation we have accounted.
Okay, thank you, sir, and best of luck here.
Thank you.
Thank you. The next question is from the line of Ayush Sabo from Choice Equity Broking Private Limited. Please go ahead.
Can you put some guidance regarding to the debt picture for the next two years? We see how much we see the debt coming down by.
Yeah, Ayush, your voice was not very clear, but what I could hear about was you wanted to understand the debt profile moving forward for the 2 years. Is that correct?
Yes, exactly.
So see, we have what we have talked about. The company is on a year-on-year basis generating a very positive cash flow from the operations, and the orders we have bagged are quite good orders, very quality orders. So going forward, we are looking at the business generating a sufficient amount of cash flow. We'll be generating positive cash flow, and that debt on a continuous basis in terms of say debt equity, in terms of debt to EBITDA will keep coming down. In terms of absolute number, maybe it could be in the range what we have indicated for the year end, say around 2,000 crores. But I think we should look at improvement from there going forward for a future period.
Are you sure there?
Yes, yes. Thank you.
Thank you.
Thank you. The next question is from the line of Nidhi Shah from ICICI Securities. Please go ahead.
Thank you so much for taking my question. So I wanted to ask about the L1s that we have approved over the year. So last quarter also you mentioned the L1s that were in a similar range. I wanted to know how much of the L1s that you have mentioned this quarter are carry forward from the beginning of the year and how much are new, and the ones that have carried forward from the beginning of the year, when do we expect these to convert into LOIs?
At the beginning of the year, we had zero carry forward of L1. Whatever is the carry forward of the year or during the year only, and we do expect all these orders to fructify before end of the financial year. Out of couple of things could come up earlier, maybe the Rajasthan water project and the Pune ring road project. Quite likely it could come in the month of February itself, and the Nagpur Gondia could come towards March. That's what is our expectation as things stand now.
All right. And my second question would be on, you mentioned that you would be also moving to some developed countries to for bidding for projects. I wanted to understand what the margin profile would be like in those countries. Typically what we have seen for other EPC companies is that margins are lower abroad, especially in developed countries. With the projects that you are bidding for as well, or is it not the case?
Our experience in overseas market is quite positive, and in fact we generate very high margin in overseas markets. So overseas continues to be a good margin generating segment for us, and we are quite focused working in overseas market.
Even the developed countries where generally margins tend to be lower, you are positive about those countries as well?
See, in overseas market, it's difficult to put developed and all, but we are not working in, say, a place like America, Northern America or Southern America. Those places we are not working, and the places we are working is neighboring countries. We are working in Africa, and we are targeting markets like Eastern European markets, Saudi Arabia, and some projects in Dubai.
All right. Thank you so much.
Thank you.
Thank you. The next question is from the line of Parvez Qazi from Nuvama Group. Please go ahead.
Hi, good afternoon everyone, and thanks for taking my question. So the first question is that of our 38,000 crore order book, what is the quantum of projects where we are yet to receive the appointed date?
No, 38,000 crore is the order book which is already there in the books. Apart from that, we have another 1,300 crore, 1,283 to be precise. With that, it's about 40,000 crores pending order book, plus 10,000 and odd crores we have L1 status.
Sir, I was asking about the appointed date. I mean, for the 38,000 crore order book, have we got the notice to proceed from our client, or are the projects already in?
All the cases, including that 1,283, we have received in all the cases notice to proceed.
Sure. The second question is, did I get it right that we expect our debt level to reduce to about 2,000 crore by the end of FY25?
Yes, that's what the target is.
Sure. And lastly, what was the capex that we have incurred in 9 months?
The capex we have incurred in the 9 months is around 250 crores.
And of that portion, what would have come in Q3?
Come again? I'm not clear on the question.
Sir, what was the capex in Q3?
In Q3, it was around 125 crores odd.
Sure, sir. Thanks and all the best.
Thank you.
Thank you. The next question is from the line of Prateek Bhandari from Art Ventures. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity. If you can give a sense of what typically is a bid success ratio and what is the current bid pipeline?
Yeah. So our bid success ratio is currently, it's typically in the range of 18 to 20%. And the pipeline, as I just mentioned, we have a very healthy pipeline. For around 2 years visibility, we have close to 3.4 lakh crores of pipeline spread across segments. So on the availability of projects, we don't see any challenge, and that's why the guidance is given for FY26 that we are targeting 25,000 crores of fresh order booking.
Okay. And of the total quantum of debtors you mentioned, which are 3,140 odd crores, how much of them would be 6 months, 6 months older?
You see, last time also I had explained that generally in our debtors, the number we are giving you, it's distributed in 3 parts, roughly one third. Is one is normal receivables, which will be say around 30 to 40 days kind of normal receivables. One third is towards retention money, which we receive as per the terms of the contract, and around one third is towards arbitration debtors. Those arbitration debtors, of that around 1,200 crores, we have already received around 668 crores by giving bank guarantee under the NITI Aayog guideline. But since accounting standard requires that the gross amount of arbitration receivable is to be shown in the books as gross receivable, and the amount we have received as liability, so that's how it gets reported in the books. So to answer you, this arbitration receivables could be more than 6 months.
More than 6 months?
Yeah, older.
That one third you mentioned about the arbitration debtors, right?
Yeah, because it takes time unless those matters are settled in the court. Even though we have received say more than 50% amount we have received, but those needs to be classified as gross amount as receivable, and unless those are settled, it remains in the books, and those are generally older cases.
Okay. And what would be the quantum of contingent liabilities on the balance sheet as on December 24?
So contingent liability as on December 24 will be around 1,400 crores.
1,400?
Yeah.
Okay. And of this, what would be the quantum of claims?
Are you asking about the claims or the variations we have to receive from our customers?
Yes.
Or
hello?
Yeah.
Yeah, I'm talking about the claims. If you can give a split of this 1,400 crores.
So these 1,400 we have talked about is contingent liability, which is in our books. Of this, around 480 odd crores, so say close to 500 crores is towards one of the royalty claim which has been put on us. So this has been set aside by Nagpur High Court, and then the same matter, the party had gone to Bombay High Court, wherein they have actually put a case against Government of Maharashtra. So that is one item. Ideally, this should have gone up, but since they have again gone into litigation, so the amount is outstanding. Closer to 500 crores is various disputes or the claims put by our subcontractors against us. So those are around 500 crores, and close to 400 crores will be pertaining to some of the tax-related litigations we are fighting.
Okay, so 500 crores of the royalty claim and 500 crores is for the subcontractor dispute, and the remaining 400 in the form of taxes and other.
Yes.
Okay. Okay, sir. Thanks for answering my questions.
Thank you.
Thank you. The next question is from the line of Vinay Prasad from Investec. Please go ahead.
Yeah, thank you. So just I had a couple of questions. The first one being on the oil and gas sector. In the previous conference call, we spoke about us having, or the industry having presented to government and ONGCs, changing the project terms, etc. So how is it? Any progress on that front which is made?
As of now, not much progress in this. Efforts are still on to get the contracting methodology and the implementation of contract administration improved. And so we have been resisting from quoting to ONGC till such time they make it. So,
Understood. If you can share some update on Bangladesh orders, where are we? Has the execution commenced again, or we'll be dropping those orders? Where are we on that?
On Bangladesh, both the governments are insisting that we do the work, both Indian government and Bangladesh government. One particular project, it is in the process where we have not commenced as yet. We have conveyed earlier also. Package 3 of a road project, WP3, where they awarded the contract 19 months later than we submitted the bid. And where we said unless rate revision is done, we will not commence the work. That project is probably going towards cancellation. And that is something which will be about 600 crores, about 600 crores value. So that is likely to go out. The other two projects, we are just waiting for the variations and others to be approved for doing the work. We have put a skeletal team there. They have not started the work. The government of India has started paying the money now. Hitherto they were not paying. Now they have started paying the money. Government of Bangladesh wants us to work. And we are just working around to see that in both the cases, both the railway projects and one of the road projects, both the cases, the variations have been approved and recommended by Government of Bangladesh to the Government of India, which is yet to be approved. We are just waiting for the approval to go full out on that. And in railway projects, there are three parts. Part 1 has been already handed over. Part 2, they have given the land now. Part 3, they are yet to give the land. And in package 1 of the road project, last 600 meters is something which they are yet to hand over to us. And there's a likelihood of discussion and settlement that 600 meter will be removed from the scope. It is already 2 years since the project deadline is completed. Even extension though, but this will prolong. They are not able to acquire that part of the land because it's more crowded place. So we are working with the both the governments, both Government of Bangladesh and Government of India, to see things are settled to the mutual satisfaction.
Understood. And so last question from my side. We spoke about maintaining 11% EBITDA margins. Now I understand 11% is after including other income, less of BG expenses. But we have done a lot higher, probably closer to 13% for the 3 consecutive quarters now in the 9 months, this quarter as well. So do you think this 11% EBITDA guidance is slightly conservative and we can still do much better? Not saying that we may still continue to deliver 13% or so, but is it slightly on the conservative side?
Our construction industry, as we keep always telling, has a lot of contingencies happening continuously. While our guidance will continue to be 11 plus, for the current year, it could be well crossing 12. And for the subsequent years or otherwise, we would say 11 plus. It could happen higher, but we would not like it to fall below 11.
Understood. Thank you so much, sir. Thank you.
Thank you. The next question is from the line of Bhumika Nair from DAM Capital. Please go ahead.
Yes, sir. Sir, on the, you spoke about the margin profile and, the interest-bearing advances, which has actually increased. As we move ahead, given that interest costs will kind of stay elevated because of this interest-bearing advances, would the margin profile then, what we've seen in the 9 months, actually continue to remain on the higher side, with PBT margins being more stable and the correct way to look at things?
So, what we have talked about, that even going forward, we should see improvement in our PBT margin. So gradually, even our PBT margin should improve.
Okay. Yeah, I mean that in which ways the PBT margin has also improved in the 9-month period. And would that be a more correct way to look at it as what we've seen in the 9 months to kind of sustain as we go ahead?
Yeah, so see, the EBITDA margin, if you see year on year, has improved, and so is PBT margin. Now, I mean, it's up to the investors or individuals how they want to look at it, but generally people look at the operating margin, and people also look at, say, PBT margin or a PAT margin.
Sure. So the other thing is in terms of capex, if you can just tell what is the status of the TBM machines, and while we've done some 200-250 crore of capex, what are we looking at for this year? And is that number, how does it look like for the next year as well?
With respect to TBM machine, at the highest level, Railway Minister had convened a meeting calling the machine manufacturers as well. We had a very good meeting. Alternatives are being attempted to bring in the machine. And while there has been a delay of a few months on account of border-related skirmishes between India and China, and the things are, I think, more or less getting resolved. Subsequent to the meeting, Foreign Secretary also visited China, all that. And I had also met Foreign Secretary in this connection. With that, I think things should find a resolution with respect to TBM. Regarding capex funding details, Ramesh will brief.
So, for this financial year, we expect to close the full capex somewhere around, say, 450 to 500 crores. And this is much lesser than what we had budgeted for the year. Now, last time also we had discussed that some of the project awards got shifted, so we have aligned our capex procurement in line with the project award, and also the tunnel boring machines also got shifted to subsequent period. So